In July 1956, a Texas-born physicist named John Kelly Jr. sat at a desk at Bell Labs in New Jersey and wrote a 10-page paper. His boss at the lab was Claude Shannon, the man who had just invented information theory. Kelly's paper did something strange. It took Shannon's formula for the rate of bits flowing through a noisy telephone wire and turned it into a formula for how much money a gambler should bet. The paper was called A New Interpretation of Information Rate. Nobody in finance read it. It sat in an engineering journal for 6 years. Then in 1962, a young math professor at MIT named Edward Thorpe read it. He took a bus to Las Vegas. He used Kelly's rule to beat blackjack with $5,000 borrowed from a tailor. Casinos changed their rules. Thorpe wrote a book. The book sold 700,000 copies. Thorpe went on to run the first market-neutral hedge fund on Wall Street. He compounded 20% a year for 19 years without a single losing quarter. The paper was about position sizing. Bet too little and your edge compounds too slowly to matter. Bet too much and one bad streak wipes you out. Kelly found the exact middle point where you grow your wealth fastest. He died of a stroke at age 41, 9 years after publishing it. He never made money from the formula. Today, his rule sizes positions at Renaissance, PIMCO, and every serious prop desk in the world. Warren Buffett's 40% bet on American Express in 1964 was a Kelly bet. Berkshire's 50% position in Apple today is a Kelly bet. And every hedge fund that has blown up in the last 50 years was running more than Kelly and did not know it. Before 1956, no one had a clean math rule for how much money to risk on a bet. Gamblers used rules of thumb. Bet a fixed dollar amount. Bet a fixed share of your bankroll. Double up after a loss. Quit when you are ahead. None of these rules had a proof. Most of them failed when the losing run came. Finance had a new theory by then. In 1952, Harry Markowitz published his paper on portfolio choice. Markowitz showed how to mix risky assets into one portfolio. He did not tell you how much of your total wealth should go into that portfolio. That part he left to judgment. In many investment books of the 1950s, the answer was plain: risk whatever feels right. Now picture a gambler in 1955 named Joe. Joe has a system. He has found that one horse at Hialeah Park wins about 55% of the time when a certain trainer is listed. The track pays him 2-to-1 on a win. That is a real edge. On each $100 Joe bets, he expects to make 65 cents in pure profit. How much of his bankroll should Joe put on the horse? If his bankroll is $1,000, should he bet $1? Should he bet 10? Should he bet 100? Should he bet all of it? Joe does not know. That is the real problem. In 1955, a man with a real edge still had no rule for size. If he bets too little, he grows too slow. At $1 a race, he earns pennies. He wastes his time. If he bets too much, one bad run kills him. At a 55% win rate, a 4-race losing streak happens about 6% of the time. That is common enough to matter. If it wipes him out, the game ends there. From zero, you cannot come back. So Joe does what most gamblers did in the 1950s. He bets 10%. He has no reason for 10%. It just feels safe. By the end of the year, after 40 races and a real edge, he is roughly where he started. His problem was not that he lacked skill. His problem was that he lacked a rule. What number should replace the guess? The odd thing is that the roots of the answer were old. In 1738, in St. Petersburg, Daniel Bernoulli gave a version of Joe's answer 218 years early. Bernoulli said, "People do not try to maximize expected dollars. They try to maximize expected utility of wealth. For many people," he said, "that utility looks like the logarithm of money." His point was simple. Your first dollar changes your life more than your 10th. Your 10,000th changes your life more than your millionth. The curve gets flatter as wealth rises. Log wealth captures that shape. But Bernoulli did not turn that idea into a full rule for repeated bets over time. By the 1950s, log utility was one choice among many. Economists treated it as a taste, not a law. It had no special standing. So Joe still had no working answer. An old insight sat on the shelf. Who would turn it into a rule a gambler could use every day? This mattered far beyond a racetrack. Joe's problem was an investor's problem. It was a trader's problem. It was an insurance problem. It was a business problem. Anytime you have an edge, finite capital, and the risk of ruin, you face the same choice. How much do you risk right now? In 1956, Wall Street still ran on gut. Big brokerage houses told clients to diversify. They did not tell them how much cash to hold and how much stock to buy. Pension funds had no formal rule for position size. Insurance firms had actuarial tables. They also used rough judgment. No one had a number that said, this is the exact share of capital that grows wealth fastest. John Larry Kelly Jr. was not a Wall Street man. He grew up in Texas. He shot pool. He played poker. He served in the Navy in World War II. He came home. He earned a PhD in physics at the University of Texas in 1953. Then he joined Bell Labs. There he met Claude Shannon. Shannon had published the founding paper of information theory in 1948. Kelly was 32 years old. He was about to solve Joe's problem. The question was how a physicist at a phone lab could answer a gambler's question better than gamblers could. Here is the gap Kelly saw. Shannon had given a clear meaning to something called information rate. In a noisy channel, if you code messages with enough care, Shannon showed there is a limit. At that limit, called channel capacity, you can send bits with almost no error. That was the great theorem. But Kelly asked a different question. What if you are not coding messages? What if you are betting on a noisy signal? What if the signal helps but still makes mistakes? Does information rate still mean anything then? He made it concrete. Suppose a gambler gets a noisy tip about which horse will win. He must bet his bankroll before each race. Now ask one hard question. What is the fastest rate at which his money can grow over time? Kelly proved that the answer is the same object Shannon had found. The gambler's maximum long-run growth rate equals the channel capacity of the signal. The growth of wealth and the flow of information were the same math. That was the bridge. A telephone wire and a betting system suddenly spoke the same language. Then, a second answer fell out of the first. It was the answer Joe needed. If you write the gambler's problem as a search for the highest long-run growth rate, one exact betting fraction appears. Not a hunch, not a custom, not a comfort level, a number. That number is F star equals open parenthesis B times P minus Q close parenthesis divided by B. Here, F star is the best fraction of bankroll to bet. B is the net odds received on a win. P is the chance of winning. Q is the chance of losing. That is the whole point in one line. Bet less than that fraction, and you grow slower than you could. Bet more than that fraction, and you also grow slower. There is one middle point. It is not safe in the usual sense. It is not timid. It is not reckless. It is the point that makes wealth grow fastest across time. Kelly wrote that number down. He did not give it a grand name. Years later, Edward Thorpe would call it the Kelly Criterion. There are 4 characters in John Kelly's paper. None of them are equations. The equation comes later. The first character is the gambler with a private wire. Kelly set up a thought test. A gambler buys a wire service. It tells him the result of a horse race a few seconds before the track does. The wire is noisy. Sometimes it is wrong, but it gives him an edge over the public odds. The question is simple. How should he bet? Think of that private wire as any real edge. A trader reads earnings right. A value investor sees a firm's worth right. A blackjack player counts the high cards right. A hedge fund model spots a true mispricing. In each case, the wire is the edge. The noise is the doubt in that edge. Joe's horse with the magic trainer is a wire. Buffett's read on Coca-Cola in 1988 was a wire. The second character is the bankroll. Call it W for wealth. At the start of each bet, the gambler has some amount of money W. After the bet, he has more or less. The key point is this: each bet is a multiplication. It is not an addition. If he bets a fraction f of his bankroll and wins, his bankroll becomes W times 1 plus f times b. Here, W is the bankroll before the bet. F is the fraction of the bankroll he risks. B is the payoff odds, the net amount won per dollar risked. If he loses, it becomes W times 1 minus f. Here, W is again the bankroll before the bet. F is the fraction of the bankroll he risks. Because each bet multiplies, a single zero is forever. A total wipeout cannot be fixed later. There is no later. The next bet never comes. In repeated betting, ruin sticks. That quiet fact is the base of the whole theory. The third character is the edge. Call it P. It is the chance of winning. It is the gambler's skill. It is what sets him apart from the crowd. If the public pays even money on a horse that wins 55% of the time, the gambler's edge is 5%. If his estimate of P is wrong, his edge is wrong. Kelly made one clean move. He assumed the gambler knows P exactly. That gives the neatest form of the problem. It is also the most dangerous assumption in the paper. The fourth character is time. Not one bet, a string of bets, an endless string. Kelly's result is about long-run growth. In any short run, luck can do anything. Over 100 bets, you may still lose. Over 10,000, if the edge is real and the size is right, you almost surely win. These four characters are all Kelly needs: wire, bankroll, edge, time. His 1956 paper stands on them. The formula that follows is the cleanest answer to one question. Given those four things, what fraction should the gambler bet? Before the formula arrives, notice how small the setup is. 10 pages, 4 moving parts. Kelly did not need utility theory. He did not need expected value in the usual form. He needed one number: the long-run growth rate of wealth. Then, he solved one calculus problem. Maximize that rate. Read off the answer. Here is the Kelly criterion for a binary bet. F star equals open paren B times P minus Q close paren divided by B. Here, F star is the optimal fraction of the bankroll to bet each round. B is the payoff odds, the net amount won per dollar risked when the bet wins. P is the probability of winning one bet. Q is the probability of losing, which is 1 minus P. Read it out loud. F star equals B times P minus Q all over B. 4 letters, 1 equation. Now put in numbers. Suppose Joe's horse wins 55% of the time. Suppose it pays 2 to 1, so P is 0.55, Q is 0.45, B is 2. The top is 2 times 0.55 minus 0.45. That is 1.1 minus 0.45. That is 0.65. Now divide by 2. You get 0.325. Joe should bet 32.5% of his bankroll. Every race, not 10%, 32.5. On a $1,000 bankroll, that is $325 each race. Remember Joe betting 10% because it felt safe. At Kelly, he should have bet more than 3 times that. The cost of caution was real. Over a year of 40 races, his Kelly-sized bankroll grows about 8 times faster than his 10% bankroll. Read the formula once more. F star equals B times P minus Q all over B. It has a plain meaning. The top term, B times P minus Q, is your expected dollar return on a $1 bet. If the horse wins 55% of the time at 2 to 1 odds, $1 earns 1.1 minus 0.45 on average. That is 65 cents. That is your edge per dollar. The bottom term, B, is the odds you must take to get that edge. So the Kelly fraction is edge over odds, expected return per dollar divided by the net payoff on offer. There is a simpler form. If you rearrange it, you get this. F star equals P minus Q divided by B. Here, F star is the optimal fraction of the bankroll to bet each round. P is the probability of winning one bet. Q is the probability of losing. B is the payoff odds. That is the form Kelly wrote in 1956. Both forms match. Both give the same number. 3 edge cases matter. First, if the bet is fair, then F star is 0. Do not bet. No edge means no size. Second, if B times P is far above Q, F star can be more than 1. That means the rule says to bet more than your bankroll. In plain terms, it says use leverage. Third, if B times P is less than Q, then F star is negative. The bet is bad. Bet the other side if you can. If you cannot, walk away. Kelly never tells you to take a negative value bet. The same idea extends past horse races. For an investment with mean excess return mu and volatility sigma, Kelly's rule becomes F star is about mu divided by sigma squared. Here, F star is the optimal fraction of wealth to place in the risky asset. Mu is the mean excess return over cash. Sigma is the volatility of returns, so sigma squared is the variance. That is return divided by variance. Edge divided by risk. Same logic. But the binary form is the one John Kelly wrote in 1956. It is the one Ed Thorpe used at blackjack tables. It is the one many great investors carry in their heads when they size a bet. It is small, it is exact. For 69 years, it has been the clean answer to Joe's question. Kelly's derivation is clean. The question is this: what fraction F maximizes the long-run growth rate of wealth over a sequence of bets? Imagine n bets. The gambler wins about n times P of them. He loses about n times Q. After all of them, his bankroll equals his starting bankroll times 1 plus F times B, raised to the number of wins, times 1 minus F, raised to the number of losses. Say that in plain words. Each win multiplies his money by 1 plus F times B. Each loss multiplies it by 1 minus F. The final bankroll is just those multipliers stacked on top of each other. So the natural thing to study is not the final bankroll by itself. That number swings too much from run to run. The right thing to study is its log. The log of a product becomes a sum of logs. Then the average log of wealth per bet settles down. That stable number is the exponential growth rate. The growth rate per bet is P times the log of 1 plus F times B, plus Q times the log of 1 minus F. Here, P is the probability of a win. F is the fraction of bankroll bet each round. B is the payoff odds. Q is the probability of a loss. Take the derivative with respect to F, set it equal to 0, solve the first-order condition. The answer falls out. The optimal F is exactly B times P minus Q all over B. Why use log at all? Why not maximize expected dollar wealth? That is the turn at the heart of Kelly's paper. If you maximize expected dollar wealth, the answer is savage. Bet everything, bet it every time, as long as the bet has positive expected value. Expected dollars are linear, compounding is not. So that rule rewards wild aggression. In finite time, wild aggression leads to ruin. One bad spin ends the game. Log utility stops that. The log of 0 is negative infinity. So log utility punishes ruin harder than any finite gain can offset. It forces survival. An investor who maximizes expected log wealth cannot rationally choose a strategy that goes broke. Here is the deeper reason. If each bet is independent and identically distributed, the long-run growth rate of wealth almost surely equals the expected log return per bet. Not in the loose sense of an average dollar outcome. Almost surely, with probability 1. Over enough bets, the investor who maximizes expected log wealth ends up with more money than any investor who uses another fixed strategy, with probability that tends to 1. This is a law of large numbers result. It is a theorem. The Kelly Criterion is not a taste. It is not a mood. It is not a risk score. It is the one bet size such that, if you run the game long enough, you end up richer than any other strategy, almost surely. Anything more aggressive ruins you in time. Anything more timid leaves money on the table in time. That is why Kelly links to Claude Shannon. Shannon showed the fastest rate a message can move through a noisy channel. Kelly showed the fastest rate wealth can compound through a noisy betting channel. The structure is the same. One side is bits per second. The other side is log dollars per bet. Both are exponential growth rates. Both are capped by the information in the signal. Kelly saw this himself. In the last part of his paper, He said the gambler with a noisy signal and the right bet size will see his money grow at Shannon's channel capacity. Information rate and wealth growth rate are the same fact in 2 units. That is why Kelly's rule does not need utility theory as its first defense. Log utility drops out of the math. It is not a taste pasted on top. You do not have to love log utility to accept Kelly. You only have to want the highest possible long-run growth rate. Here is the hard part. Kelly's formula assumes you know P exactly. You never do. You estimate it. The cost of getting P wrong is not balanced, and is harsh on one side. Run the numbers. If the true Kelly fraction is F star, and you bet double that, 2F star, your long-run growth rate is exactly 0. You do not grow. You do not shrink in the limit by rate. You stall. If you bet any fraction between 0 and 2F star, you still grow. If you bet more than 2F star, you shrink with probability 1. Sooner or later, you go broke. Now suppose your estimate of P is wrong. You think the win rate is 55%. The real rate is 52. Your estimated Kelly fraction is 32%. The true Kelly fraction is about 12%. You are betting about 2.7 times true Kelly. Your long-run growth rate is negative. You seem to have an edge. You are in fact bleeding. In real markets, this is normal. No investor knows P exactly. No hedge fund model gives probabilities without error. Volatility comes in clusters. Regimes change. Correlations that held for 10 years can break in a week. A Kelly fraction built from old data is a Kelly fraction built from a wrong P. Go back to Joe. Joe thought his edge was 55%. Kelly told him to bet 32.5%. But if his true edge is 51%, not 55, then Kelly says bet 2%, not 32. Joe has overstated his edge by 4 points. If he bets 32, he is betting 16 times true Kelly. His long-run growth rate turns hard negative. His bankroll shrinks. Each win feels like proof. Over 1,000 races, he ends up broke. This is the most dangerous Kelly failure. You think you have more edge than you do. The trait learned a rough cure. Use half Kelly. Bet half the fraction the formula gives. Half Kelly keeps about 75% of the maximum long-run growth rate, but it cuts the volatility of log wealth by about half. It acts as if your edge were smaller. For people who estimate P in the real world, half Kelly is much safer. Quarter Kelly is safer still. It keeps about 44% of the growth rate and cuts variance to about 1/4. For automated systems and soft edges, quarter Kelly is now a common default. There is a second wall, correlation. Kelly's clean formula is for one bet at a time. It assumes the bets stand apart. Real portfolios hold many bets at once, 5, 50, more. When those positions move together, the true Kelly fraction for the whole book is lower than the sum of the parts, sometimes much lower. 2 uncorrelated 10% Kelly bets can sit side by side. 2 10% bets with 90% correlation are close to 1 20% bet. That should be cut back. Portfolios that ignore correlation stack one overbet on top of another. There is a third wall. Paul Samuelson fought Kelly for years. Samuelson, the MIT Nobel laureate, said log utility is only one utility function among many. Kelly does not maximize expected utility for the rest. He was right. If you care most about terminal wealth at one fixed date, or if your horizon is short, Kelly is not always best. Many academic economists sided with Samuelson through the 1970s and 1980s. That is one reason Kelly sizing stayed fringe on Wall Street for so long. The reply came from William Ziemba, David Leuenberger, and at last Harry Markowitz himself. It was simple. If your horizon is long, pension long, lifetime long, decade after decade long, log utility is not just one taste among many. It is the rule that maximizes the chance of beating rival strategies. Whatever utility you claim, if you want to end up richer than the person next to you over 30 years, Kelly has a hard case. The formula works when you know P. The wall is that you never know P. Every real use of Kelly is a fight against one cruel asymmetry. If you bet too little, you grow too slow. If you bet too much, you die. The formula is exact. Your inputs are not. That gap is where most Kelly disasters live. Kelly solved Joe's problem in 1956, but Joe never met him. The problem became a trade only when other people learned how to estimate P, cut it in half, and bet the rest. The first clean use came in blackjack. Edward Thorpe was 30, and at MIT when he read Kelly's paper in 1960. He saw at once that it fit a game where a card counter could estimate P with real care. Card counting gives the player a known edge when the deck is rich in tens and aces. Thorpe went to Las Vegas with $5,000. He came home with $21,000. It took 1 week. Beat the Dealer came out in 1962. Casinos changed the shoe after that. They shuffled more often. They banned card counters. Thorpe's system stayed unbeatable in theory. That is why the casinos had to change the game in practice. But blackjack was only the first wave. Thorpe's second career mattered more. In 1969, he and a partner started Convertible Hedge Associates. Later it became Princeton Newport Partners. It was the first market-neutral hedge fund in history. That means it tried to strip out broad market moves and keep the edge in the trade itself. Thorpe used Kelly sizing on every position. 19 years later, prosecutors shut the firm down for reasons that had nothing to do with his strategy. By then, Princeton Newport had compounded at 20% a year after fees. It had done that without a single losing quarter. Thorpe's own wealth from the fund and his later work rose into the high hundreds of millions. His book spread the idea even wider. Beat the Dealer sold more than 700,000 copies. Beat the Market followed in 1967. That was 4 years before Black & Scholes wrote down their option pricing formula. Thorpe was already using something like Black-Scholes at his desk. Then Wall Street took its turn. Bill Gross, who co-founded PIMCO, read Beat the Dealer when he was young. He went to Las Vegas for a summer. He turned $200 into $10,000 with Kelly sizing at blackjack. Later, he ran the world's largest bond fund for 40 years. By the 2000s, he managed more than $1 trillion. Kelly sizing sat in his head each time he bought a bond. Then came Berkshire Hathaway. Warren Buffett never wrote down the Kelly formula. He learned concentration from Benjamin Graham and from his own bent of mind. Still, his portfolio has a Kelly shape. In 1964, Buffett put 40% of his partnership into American Express. The salad oil scandal had crushed the stock. He saw a large edge and acted with size. That is a textbook Kelly kind of bet. In 1988, he put a quarter of Berkshire into Coca-Cola. In 2016, he began buying Apple. By 2020, Apple was nearly half of Berkshire's public equity portfolio. Charlie Munger said in interviews that Kelly logic described how he and Buffett think about size, even if they do not compute the formula. At Berkshire's 2019 shareholders meeting, Munger put it in plain words. Whoever developed that formula has an approach to life similar to mine. Now the idea sits deep inside modern finance. Renaissance Technologies, the most profitable hedge fund in history, runs a version of Vector Kelly across thousands of positions. 2 Sigma uses Fractional Kelly in its risk systems. So does D.E. Shaw. So does Citadel. Every prop desk with an edge thinks in Kelly terms, whether it uses the name or not. The other side matters too. The Recs tell the same story in reverse. Long-term capital blew up in 1998. Amaranth blew up in 2006. Archegos blew up in 2021. All of them ran far above Kelly on correlated bets. They did not have the fraction. They did not grasp how much their positions moved together. When the world turned, leverage did the rest. That brings us back to Joe. Joe the gambler did not know how much to bet. Kelly gave him a number. If his estimate of P was right, the formula said to bet 32.5% of his bankroll on each race. The modern answer is more cautious. Cut that in half. Bet about 16% instead. That protects you from the plain fact that your estimate of P may be wrong. That is the working form used by professionals. Full Kelly is for proofs. Half Kelly or quarter Kelly is for real money. If you have an investment strategy with a positive expected return and an estimate of your volatility, you can size it the same way. Compute your continuous Kelly fraction. It is mu divided by sigma squared. Here, mu is your expected return. Sigma is your volatility. Sigma squared is your variance. Then cut that number in half. Use that as your starting position size. If the market regime turns against you, cut it to quarter Kelly until you know what changed. Never go above full Kelly. Never add up to full Kelly across bets that rise and fall together. If you keep that one rule, half Kelly across real-world correlations, you are using a 69-year-old Bell Labs idea to set the most important number in your portfolio. Bet to maximize log wealth, not dollar wealth. The Kelly Criterion, published by a Bell Labs physicist in 1956 and ignored until Edward Thorpe took it to Las Vegas in 1962, became the quiet architecture of Princeton Newport, PIMCO, and Berkshire Hathaway's concentrated positions, and every hedge fund that blew up in the last 50 years was running more than Kelly and did not know it. Cut the Kelly fraction in half, and you are betting the way the best gamblers and investors in history have been betting for the last 70 years.